investors are investing across different asset classes, namely real estate, precious metals, stocks, bonds, and recently crypto assets, right? Now, it is very important that you build a holistic portfolio which is commensurate for the risk that you take as well as for the returns that are generated. And hence, asset allocation becomes a very important uh, point of view. So, what is asset allocation really? Asset allocation is deciding how much you will allocate across these various asset classes that we spoke about, keeping in mind your risk tolerance. Okay, so let us say that you are an individual who is in the senior citizens category. So, your risk tolerance will not be that high. So, your allocation to debt would be lower than maybe fixed deposits or maybe to debt or maybe even to precious metals and real estate, right? There would be somebody who is in his middle age and is looking to generate a steady income stream. So there, this person's asset allocation would be geared more towards regular income generating streams like debt securities, debt mutual funds, where real estate assets which are rental properties, and a portion of equity which is into stocks which are generating dividend, right? So this is how a middle-aged investor would be looking at. Now, if you consider a young individual investor, what is he looking for? He's looking to build wealth, right? And he has got a great career ahead of him. So his risk-taking appetite is significantly higher, and hence you would have youngsters investing bulk of their savings into equities which give you higher returns, but they also have higher risks, right? So deciding the amount of money that you would allocate across these various asset classes is essentially the function of asset allocation. Now, what does asset allocation do? As I told you earlier, it is to maximize your returns while minimizing your risk, right? And we also looked at the various aspects of a youngster and a middle-aged person as well as a senior citizen. Now, if you are allocating across these assets and you want to maximize your wealth, it is very important for an equity investor particularly to see to it that he gets the maximum return or the maximum bang for his buck while investing. So let us say you are very gung-ho about a particular stock and you are very convinced that the stock is a multi-bagger. But if you invest only 2 to 3% of your net worth into that stock, is it really going to move the needle? Perhaps not, right? You may double your money in that, but its contribution to your overall equity portfolio will be very low. So another aspect of asset allocation as far as equity investing is concerned is that you must bet your money where your conviction lies, right? So if you have a portfolio of 50 stocks, it will be well diversified and it will be very good from the point of view of minimizing risk. But your returns will also be of a meager return because you are not doing justice with your portfolio in terms of asset allocation. But if you have a portfolio of 10 stocks, where all these stocks are high growth and you diversify the risk by investing across different sectors, what is essentially happening is that you are building a growth portfolio for yourself. You are banking on the stocks which are definitely a high conviction for you, and hence you are maximizing your return potential while you are diversifying the risk. Another aspect to consider while allocating assets is the tenure for which you are investing. So if you believe that a stock has got a fairly long runway of growth, what you will be looking to do? You will be looking to allocate substantially across that equity stock and letting your profits run. So it's not about getting out of that stock just because it is run up quite a bit. It is about staying invested with that stock over a fairly long period of time until you're convinced that the growth from that stock is going to take off. So this is how, by allocating your portfolio across your high conviction ideas, okay, looking to maximize returns and at the same time diversifying the risk, will help you with your asset allocation. Another thing that you have to understand about allocation is that as you mature in life, or as you move, as you age, your portfolio needs to be tailored to the risk that you can tolerate, right? So in your later age, you do not want the risk of equity drawdowns happening. So you would want to have a more stable kind of income because your requirements are not that significantly high, and your investment goals are also being met. So what you will be doing in that case is, gradually as you age in life, your portfolio would be diversifying from high risk and high growth equities to a more of a moderate risk and stable returns and stable revenue stream kind of a portfolio. So for this, you need to change your asset allocation over a period of time, and you need to reallocate across the different buckets that you are investing in. So we have to keep in mind 4 or 5 things while deciding asset allocation. One is the equity risk that you are willing to take. 2 is what are the investment goals that you have. 3rd is what kind of returns that you are looking to accept. 5th is looking at your rebalancing of your asset allocation so that it does not, move too much in direction of being skewed, where the failure of one asset class can jeopardize your entire investment strategy and goals, and subjecting you to too much risk. And 4th is to periodically readjust the allocations across the different asset classes so that it is truly representative of generating wealth for you, maintaining a stable stream of income, and at the same time being commensurately reflective of the risk tolerance that you have, which changes as you age.